Assalamu alaikum wa rahmatullahi wa barakatuh, and welcome to another episode of Investment Matters. I'm your host Adnan Bazir, and in tonight's lineup we'll be doing the weekly market update with Abdul Rauf Hanslow, and then we'll be doing the investment analysis with Abdulaziz Davids, and we'll continue our series on financial planning with Muhammad Jaffer from Mojaf Financial Services. So do stay tuned as we'll go over to Abdul Rauf to take us through the weekly market update. Shukran. Assalamu alaikum and welcome back to Investment Matters, as we'll have our discussion on investment analysis with Abdulaziz Davids. He's the head of research at Kagiso Asset Management. Assalamu alaikum, Abdul.
Wa alaikum salam wa rahmatullahi wa barakatuh, Adnan, and to our viewers as well.
Wa alaikum salam, Abdul. Last week we looked at the US situation, economic situation. We touched on the monetary policy and the sort of debt levels and the measures that they've put in place. I think also to maybe bring it back to the global village perspective. I mean, that's what we're currently living in. And also to touch on the South African sort of economy and market. I mean, the foreign participation, how does that leave South Africa and the rest of the world?
Very good question. Shukran for that, Adnan. And again, just to give perspective to our viewers, it might seem that we're discussing topics that are abstract and not relevant. But with the global economy, like you say, being so interconnected, what happens in the US and some of the actions by the central bankers in Europe and the US does affect us, because it affects the flow of capital products and services, and ultimately what happens on our stock market, in our economy as well. So to give you a perspective, you asked about the foreigners into our market. What that refers to is basically, if you look at our stock exchange, obviously the companies traded on the stock exchange like a Sasol and MTN, Anglo American, Bulletin, they've got South African shareholders, but they also have international shareholders. Yes. Now the JSE, even with our foreign exchange controls, does have some sort of openness to it, where foreigners can buy and sell stocks listed on the JSE as well. Now typically what you'll find is that for us as South African investors, for some of our sort of, with the Foreign Exchange Control Acts, for example, we are not allowed to take all our money offshore. So we are forced to invest in companies in South Africa. Yes. For foreigners who don't have those exchange control sort of problems, they can invest anywhere in the world. What we have seen is that, and just briefly to give the perspective, with the quantitative easing that we discussed last week and the aggressive monetary policies that we've seen in the US, the effect of a reduction in interest rates basically effectively creates money. And effectively what we've seen is that with the lowering of interest rates in the US, I mentioned last week that US Treasury bills, for example, 2-year Treasuries at 0.23%, 10-year Treasuries at below 2%. That reduction in interest rates mean that people that are looking for, if you look at pensioners in the US, widowers, for example, that are looking for yield, they need to now look at alternative sources. If you were used to getting 5% on your US bonds, for example, you now look somewhere else to get that similar yield, given the fact that the US now is giving you much lower than that. So foreigners initially were attracted by the fact that our yields were much higher than what they could get in the US. And also given what we've seen with austerity in Europe and in some of other developed markets, the economic growth rates in those markets have been stagnant. So South Africa is still offering some level of economic growth. You've got a twin benefit of higher yields in terms of dividend yields and earnings yields, and also a semblance of better growth conceivably from a foreign perspective from our market as well.
So I mean, and from what you're saying now, I presume that we've seen quite an increase in the monetary flows into the South African market.
That's right.
I mean, is that a good thing or a bad thing?
Well, it's got benefits. I mean, we've just to give you a perspective, 6 years ago, the average sort of company in South Africa had about less than 10% foreign shareholding. Today, that's sitting at well above 40%. So we've seen a fourfold increase in terms of foreign participation, especially in our industrial sector. So those companies that are not involved in, for example, resources or mining, because foreigners are acutely aware of the issues around mining, both in South Africa and globally as well. But we've seen that increase coming through. What we've also seen is that foreigners are attracted by South Africa as a proxy for other emerging markets. We've got a fairly open and tradable sort of market. So that is another sort of attraction that they saw in South Africa. And then also I think what we've seen is that given our sort of very solid accountability and transparency legislation, both in terms of the accounting and auditing standards, but also in terms of the JSE as a platform itself, in terms of fulfillment of trades, etc., that naturally attracts foreign investors and appeals to them as well.
I mean, Abdul, we saw end of 2012, we saw JSE levels reaching high levels of 40,000 points. I mean, it's hovering around 39,000 at the moment. I mean, just bring it down to basics, demand and supply. We see more money coming in, so obviously that affects the share prices. And a lot of people feel that the local South African market is fairly highly priced or valued. Is that the case?
Yeah, from our vantage point, given that we are much more exposed to the South African economy, we see what we call a dichotomy. On the one hand, the economy is fairly weak. Last week we talked about the increase in social spending, for example, as opposed to infrastructure spending. The fact that our debt to GDP ratio is increasing and going in the wrong direction. Growth has been stagnant and much lower compared to the rest of Africa, for example.
So I mean, if you then look at the various sectors, and you said we've really seen big inflows into the industrial sector, and probably just before we end off, I mean, do we still see value in these companies?
Bearing in mind that Kagiso Asset Management, our process is very much bottom up. So we look at each company on a company by company basis. So we would never just buy the retail index, for example, or just buy any industrial company. We'll do our homework in terms of looking at the financials, understanding the business model, speaking to management, etc. So one has to be very selective. And unfortunately for our viewers and for our investors, you really need to critically ask your fund manager those hard questions. Is he doing his homework, or is he just buying, a retail sector, for example?
Shukran for that, Abdul. After the break, we'll continue with our financial planning series with Mohammed Jaffer, so do stay tuned. Shukran. Assalamu alaikum and welcome back to Investment Matters, as we'll continue our series on financial planning with Mohammed Jaffer, the key individual of Mojaf Financial Services, in the studio. Assalamu alaikum, Mohammed.
Wa alaikum salam, Adnan, to you and to our beloved viewers.
Mohammed, last week we looked at initiation of our discussion on retirement planning, and we touched on the retirement annuity investment product as a tool to use for your retirement savings. I think probably also as a good discussion is to understand retirement annuity being a flexible form of a retirement product, that you can also use your discretionary monies to save towards retirement compared to the other products that we'll still touch on.
Yeah. Adnan, I think it's very important for the listeners or viewers to understand that retirement planning is not just a planning, the same type of mindset. You can't use the same type of mindset when you plan for retirement planning with your retirement products as you were going to use for your unit trusts that you're going to use to build up capital that you maybe need for as a deposit for a property, and maybe to buy your car cash, those type of things. The particularly in current market conditions, it's very important that you look, and this is where you have, as you've mentioned, you've got the latitude to select the underlying investments that you now currently look at, for instance, maybe income funds or dividend funds, because with the constraints or the difficulty that fund managers are finding to find value and to give you that over the top performance. At least if you're not going to get those fantastic performance, at least you're going to get that income stream that's going to flow into your portfolio. So yes, it's important that you construct it properly.
Yeah.
That not only goes for your retirement of annuity, but it goes across the board, all your retirement products. The only difference is, unfortunately, is that with the other products, for argument's sake, if you've got the next product that you want to look at is, for instance, the pension fund. The pension fund, you unfortunately don't necessarily have the freedom to choose the underlying investment as well. They might give you what we call life stages portfolios, where, for argument's sake, for the young person who's just starting, they will call it an aggressive fund. Then for the person who's maybe in their 35 to 40, they'll call it a moderate fund. And then after the age of 45, then you would look at, for instance, a moderate to conservative fund. Over 50, you look at a conservative fund. That is the main difference when it comes to your fund selection, comparing a pension and provident fund. Now, we must understand that with a retirement annuity and a provident, a pension fund, and a provident fund for that matter, that over and above the returns that we get from the fund manager, the performance of the fund, if, for argument's sake, Abdurrauf, you are one of the fortunate ones whose marginal tax rate is 40%, for every 1,000 rands that you're contributing towards your pension fund and to your retirement annuity, SARS is paying 400 rand and you are paying the 600 rand, because SARS is giving you the tax break. So you need to add that on top of the performance that you are getting from the fund manager. Now, say for instance, if we're saying it is a 40, there already you have a 40% return. Now, if the fund manager gives us, for argument's sake, another 10% return, you're talking of 50%. Then on top of that, the growth within the fund, within the product, does not get taxed. Any profit that the retirement product, the fund makes, does not get taxed at all. So you get that windfall as well. So from a portfolio point of view, it's very important. And I know over the last couple of years, the retirement industry has been lashed by in the open media, in the media, about, and correctly so also, for the funds, the cost that was associated with retirement savings, because there were guilty parties in stripping financial retirement products. If it wasn't the insuring houses, it was the advisors who were taking punitive commission on these products. And if you add all these things, if you look at it over an extended period, the people didn't see the returns.
Yeah.
But those type of things were exposed, and we must grant the investment industry also the fact that they were wrapped over the knuckles, and they have now come up with products that has got a fraction of the cost of the historical products. Now, Adnan, the point that I also want to clarify is, if we look at, for argument's sake, a retirement annuity and a pension fund, the main difference between a retirement annuity, a pension fund, and a provident fund, firstly, a retirement annuity, once you start investing in a retirement annuity, you will not be able to access the funds until you retire from the fund after the age of 55. So 55 and beyond, you will have excess up to 1/3 of the fund value,
Yes.
As a lump sum, and the balance must be either transferred into a living annuity or a life annuity. Now, after the 1/3, if you are a disciplined investor and you end up with a significant amount in your retirement savings, that 1/3 can make up a substantial amount.
Yes.
And if you are a investor that worked very carefully and properly with your retirement saving, for argument's sake, if you now at the end of your investment period have a fund value of 3 million, a 1/3 will give you now $1 million.
Yes.
Now that million, if you say, okay, I want to take the 1/3, the 1 million, to settle whatever debt I've got and whatever it is,
Yes.
I want to do. That 1/3, the first 300,000 rands will be tax-free. And the first 315,000 will be tax free. The next 315,000 will be taxed at 18%. The next 300 at 27%, and thereafter at 36%. There also, it is very important that you withdraw your funds very carefully. Now that goes, it's the same with a pension fund. The difference, however, is with a retirement annuity, you will never be able to access unless under very, very stringent and limited circumstances can you access the fund. One of them is at death. Then the funds can be accessed in a retirement annuity, which goes to your beneficiaries. With a pension fund, if you leave the employee of your employer and you then resign from the company, you now can access the funds.
I think we should continue on the pension discussions and tax implications. So do join us again next week to continue our discussion on financial planning with Muhammad Jaffer. Shukran. Assalamu alaikum wa rahmatullahi wa barakatuh.